It's my pleasure today to speak with Nell Minow. Nell has been described in the FT as the doyenne of American corporate governance. She's been described elsewhere as the queen of corporate governance as well. And so it is an absolute pleasure and privilege to have her speak with me today. Nell, I came across your book, which was co-authored with Robert Monks fairly recently, and it was this book here, Power and Accountability. And I have to say, I absolutely love what I've read of it so far. I haven't read the whole thing, but I've picked out some really interesting things so far. And not least, what I like about it is the typography. It's very, very 90s. And I particularly like that. And if I'm not mistaken, it was published in 1991. Is that correct?
That's right.
Wow. So it's marking its 30th anniversary this year, then, its 30th birthday.
My goodness, I hadn't thought about that, but you're right.
You don't by any chance have an exact birthday date, do you?
I don't. I think it was in the summer, though, so we must be coming right up to it.
Fantastic. What really interested me about the book and what I've looked at it so far is how it is 30 years old. And despite the fact that it is 30 years old, there's a lot of salience in what it is that you and Robert wrote about at the time, 30 years ago. And I just wanted to think about that for a moment and just read the quotation on the front cover and get your thoughts on that. So this is really quite powerful. It really talks to the impact and I would say, the significance of corporate governance. So this quote reads, "Corporations determine far more than any other institution the air we breathe, the quality of the water we drink, even where we live. Yet they are not accountable to anyone." Now, that is really quite an interesting proposition, that we've got these entities, these bodies that are so influential, are so powerful, that they have so much influence over what it is that we need to live, yet they're not accountable to anybody. I'd like to pass those two things out, if I may, to start with, Nell. And first of all, thinking about the influence of the corporation as it was in 1991 when you wrote that book, and how it is now. How have things changed in terms of the influence of the corporation since then?
Well, I'm going to quote another book that you may know and say that in some respects, it's the best of times and the worst of times, because in some respects, we've come far further than Bob and I could have anticipated back then. But in other respects, things have gotten so much worse than even our most dismal prognostications. So, but let me just begin with the overall point. And that is, if you think about pollution for a moment, you think about the air and the water, as mentioned on the cover of the book. My first job when I got out of law school was at the Environmental Protection Agency under the most progressive environmental president we've ever had, who was Jimmy Carter. And then as I left, Ronald Reagan, who was the most anti-environment president we had until Trump, was coming in. And I got to see the really up close and personal, the influence that corporations have. And if I can skip ahead for just a moment, there was a woman named Brooksley Bourne who was in the government, and she was concerned about the subprime mortgages. She was concerned about the derivative securities, and she wanted to put a notice in the Federal Register saying, "We're concerned about this. We'd like to know more about it. We're going to solicit some information and consider whether we need to have some federal regulation about it." And that seems like a pretty modest statement. She just wanted to look at it. And she got a phone call from the Secretary of the Treasury, Larry Summers, who said, "I have 13 bankers in my office right now who tell me that if you even look into the possibility of regulating derivative securities, the entire economy will fall immediately. You're not even allowed to look at it." And we all know how that turned out. It was a disaster. And that gives you some idea of the influence corporations have. So going back to the idea of the air and the water for a moment, even if the United States, even if Jimmy Carter were still president, and even if the United States passed the most aggressive rules possible on protecting the air and the water, it wouldn't matter because it's a big world, and the air and the water don't respect the kind of atlas borders that we think are so important.
Yeah.
And things happen in Canada and Mexico that affect us. Things happen in China that affect us a couple of days later. And there's really nothing you can do within the boundaries of any country, or much less city, that will resolve this problem. We have to work together as a whole. And the exact same thing applies to corporations. In the United States, we have what we call the Delaware problem, which is that since 1789, corporate governance has been a matter of state law, and Delaware pretty much owns that area. And so Delaware, which is the second smallest state in which you can drive across between breakfast and lunch, most of the large corporations are incorporated there, and yet they don't have any, they don't experience any kinds of effects of the corporations. Really, you know, they have a post office box, and they pay a tiny amount of state excise franchise tax, and that's about it. And as a result, they then get the benefits of pretty much a get out of jail free card, quite literally, to do whatever they want to do, because Delaware doesn't feel the effects. And then you look at that on a global scale, where we have the Cayman Islands as kind of the Delaware of the world, where if things are even too strict in Delaware, a company can continue to have all the same operations, all the same locations, and incorporate in the Cayman Islands or the Isle of Man, and be protected really from any kind of oversight.
Yeah, wow. So that leads very nicely onto the part of that quote about accountability. So is there still a real problem then of this? I don't know even if you would call it an untethering, even because that implies that there was a tethering in the first place between power and accountability in the corporate world. Would you say there has been any progress, or perhaps not, based on what you were saying about Delaware, in terms of making these large, powerful organizations more accountable in terms of, certainly in terms of the social, what might be called externalities of their operations?
Well, externalities, of course, is the key term. And as somebody who worked in the government for 8 years, I can tell you that the primary justification for any kind of a government rule is to minimize externalities. There are things that there are decisions that are best made by the market, and then there are decisions that the market is just terrible at. And externalities, as we say in the book, a corporation is an externalizing machine. They're set up with perpetual life to just throw off as many of the costs and keep as much of the profits as they possibly can. And the only way to provide any kind of oversight is through the government. Now, I will say, I'm at the very moment today, I'm working on a report about this year's proxy season. And when we wrote the book, the idea that there would be majority votes with large institutional investors casting their proxy votes contrary to the recommendations of management on CEO pay, on disclosure of political contributions, on climate change, was a dream we hardly dared to imagine. And yet it is happening. And I think, so I think that the market, you can't count out the market-based interest in ESG, the fastest growing area of investment, the interest in B corporations shows that that we're seeing a demographic shift. The millennials are vastly more committed to this broader look at business and to more accountability than their parents.
Yeah, that's very good news, and that is really making people pay attention. I see far more in things like the Financial Times on ESG and ESG related topics, whether it's advertising seminars or products or training or whatever it is, than I've ever seen before. So that is really, really good news. I wonder, do you have any concerns about what you might call greenwashing, where a lot of companies are ticking a box in relation to ESG, where they're saying, oh, well, yeah, ESG, that's great, we do this. and then they're ticking the box, and there's a lot of branding and a lot of marketing and imagery around that without necessarily moving the needle in terms of their operations. Do you have a concern about that?
Oh, I have tremendous concerns about it. I think that that's kind of a good news, bad news situation. It's great that there's so much focus on ESG, but the appetite for ESG is far in excess of our ability to implement it in a thoughtful way. So let's talk about E, S, and G, okay, because
Yes.
they're three separate things. ESG stands, of course, for environment, social, and governance. I feel, this is perhaps a little parochial of me because this is where I've spent most of my time, but I feel that we're pretty solid on governance. There are still some enterprises, there's some governance washing, if you wish.
Yeah.
There are still some governance metrics that are based on what we can count rather than what counts. And I
Yes.
don't care whether they have their governance policies on their website or not. And I don't care about what I call resume independence. It's too easy to get around it. What I care about is how well does the board make the tough decisions? And those decisions, of course, are on CEO pay, on acquisitions, on disclosure, on political contributions. And that's either a good board or a bad board. And I don't care whether they went to summer camp together or, or whether they just picked some random guy off the street. Diversity, of course, very important, but that comes under S. Okay, so governance, I think we have a pretty good understanding of what the difference is between good governance and bad governance. And environment, that is a tricky one because obviously it's very sector specific. Yes. And you're seeing companies that perhaps have paid a fine for some kind of environmental violation. They may look bad, but they may actually be better because they've literally cleaned up their act than companies that haven't. So it's not always easy on the environmental stuff. What you hope for there is better disclosure. And I think SASB has made some terrific strides there and looks to be on the way to becoming a standard. So that's E. Now we come to the quagmire that is S. And I think we just have to understand that S is going to surprise us all. S stands for surprise. S is going to surprise us all the time. If you had said 5 years ago that we would have the movement on Me Too and on Black Lives Matter that we have now, it would have been very difficult to predict. If just as it would be difficult to predict the pandemic. I don't think there was a boardroom in the world in 2018 that anticipated the impact of a possible pandemic. So S is a moving target, and the best you can do, I think I do have a lot of concerns. The flip side of the success of ESG, of the visibility of ESG, is that everybody is just adding those initials to their business card. Yep. And sometimes that's meaningful and sometimes it isn't. And I just talked to a consultant who was working on some kind of an ESG ranking. And I told him that the underlying data he was looking at was very fishy. And I think, we're definitely in the earliest stages of understanding what ESG means, but I do feel that we're making very good progress.
Yeah, very interesting. Interesting what you say about the S and the S standing for surprise. I think that's an apt way of putting it, because it seems like you mentioned Me Too and you mentioned Black Lives Matter, and it seems like in both of those areas, both of those things have been eruptions. They've been societal eruptions, if you like, of long-standing problems where people who haven't been in positions of power have long had to deal with certain negative situations, abuses, and they've not been heard. And then all of a sudden it's like, boom, explode. And almost that explosion has had a virulent effect in the sense that it's spread quickly and everybody's talking about it. So like you say, it's one of those situations in terms of the S where it's, to my mind, it's got to be principle centered. We've got to deal with people in a principle centered way. So we're not trying to just roll things back all the time or mess about with, well, we're going to do more of this now and less of that the other, because yes, there are rights to be wrong. There are wrongs to be righted, so to speak. but it seems that it really highlights the need for this consistent approach for everybody, essentially, dealing with people consistently based, irrespective of where they're coming from, what the race is, what the gender is, the ethnicity, and all these different things. And I suppose that really does then does play into the G in terms of the governance, in terms of, what are the standards that we apply here? What are the rules that we're going to live by? Would you say that's a fair comment?
I do think that's a fair comment. There are two key points that I want to make about it. One is that this is not a new concern. And I think the government has set a good pattern for us to look at. For example, following various corruption scandals, the government has certain indicia that it looks at when it's trying to determine the culpability of a corporation. And one is, this seems very simple. Do you treat the top level of the executives the same way you treat the lower level? In other words, if the lower level guy is going to get fired for a Me Too violation, would you treat the CEO the same way? And if you can't prove that you've got a consistent policy all the way through, then the penalty is much, much, much worse. And similarly, they look at what kind of whistleblower protections there are. If you are, because Lord knows, we have seen over and over again that companies really get into trouble when they don't listen to bad news. So you really, as painful as it is, whether, I used to say to my children, you get in trouble at school, you come home and tell me about it, we'll do whatever it takes. But if I hear about it from the school first, you're grounded for the rest of your life, So you want to have that same policy at the office and say, and this is, what I used to say to my staff. They say, if you have a problem, I have a problem, but I refuse to be responsible for it unless you've brought it to my attention. Not only that, you're not allowed to bring a problem to me unless you have a proposed solution. Otherwise, it's just whining. It's not problem solving. So I want to hear your proposed solution, and it has to cost less than the problem because we can't afford it otherwise. So that's your part of your job. So it's very, very important. So you can do these structural things that will help you when the bad surprises come in. It will help you pivot as quickly as possible. But the most important point I want to make about ESG is the one that I think is overlooked all the time. I think we can acknowledge that the accounting principles that we use, there's a reason that they're called generally accepted accounting principles and not certifiably accurate accounting principles, because that's really what they are. So they're pretty good. The accounting that we use in the US, it goes back to the 19th century. They're pretty good at telling you the value of your hard assets. They're pretty good at telling you what the present value is of some expected stream of revenue. They're pretty good at that. What they're terrible at is the very thing that every annual report says is their most important asset. They're terrible at valuing human capital. They don't look at things like turnover and investment and training in the same way that they look at buying a building. And ESG, I think, is to fill the gap, so to speak, that ESG is, the generally accepted accounting principles will tell you what your value is today, but ESG should be about what your risk is tomorrow and 10 years from now, what your risk is. And so to generally accepted accounting principles that is absolutely essential. And I will go to the mat in arguing that there is simply no trade-off of any kind, that it is not, you're not saying, well, I don't like the term triple bottom line, because the reason it's called the bottom is that there's just one of it. It's the bottom line. And so to me, all of this is bottom line. You're trying to create a sustainable business enterprise that is going to create shareholder value over the long term. Okay, well, the best way to do that is to manage risk well. And I think that's where ESG comes in. So I think it's completely financial and indispensable.
Absolutely. No, really powerful points made there, Nell, and completely accepted. I want to go back to a point that you made, because you were very strong when you spoke about the G in ESG, governance, and there's good governance and bad governance, and And you're very clear on that. It's quite binary from the way that you presented it. So I'd just like to ask you, first of all, we're kind of rolling things back here, but I quite like to go to first principles, so to speak. How is it that you would define corporate governance?
Well, corporate governance is basically how you decide where the corporation is going. And the entire idea of corporate governance of publicly traded companies really comes down to one thing, and that is minimizing agency costs. Going back to absolute beginning, you're going to take better care of a car you own than the car you rent.
Yeah.
And the law recognizes that, and it imposes different standards. Say, for example, if you ask me as a favor to take care of your car versus if you pay me to take care of your car, versus if you are my underage minor ward and I'm your guardian and I'm taking care of your car. There are different levels of responsibility for all of those things because we recognize the agency costs. We recognize that if we didn't have that and you're my ward, and why wouldn't I just sell the car and keep the money? You're young, you can't do anything about it. Well, the law is there to protect you. And the same thing is true with public companies. What can we do to make sure that every dollar spent by the corporation is to benefit the sustainable long-term wealth of the corporation and return to shareholders, instead of saying, paying for the CEO's second home, which I am familiar with a company that did do that. And how do we do that? Well, we have a system of corporate governance in place that got checks and balances. You've got the board of directors who are supposed to be independent and exercising some sort of at the level of the forest rather than the trees. Then you've got the trees people, that's the executives, and the leaves people, that's the lower level staff. And then you also have the shareholders to make sure that, in theory, that if the board of directors isn't doing their job, that they get booted out in favor of better ones. But in reality, there are, directors are nominated by the insiders and no one runs against them, and they count the votes. So it's not really what you consider to be an election.
Yeah, it's very interesting, isn't it, how independence is stressed so highly in relation to corporate governance, but it seems to be difficult to achieve because invariably the people who are in and around that particular organization are those that are known by those already in situ. So
we won't use the term Stockholm syndrome, but the fact is that you've got 11 people who meet maybe 4 times a year, and then you've got a strong, dynamic, visionary leader who controls their service on the board, their compensation on the board, the information they receive. And it's very hard not to be kind of sucked in by that. I also, as I said, I'm not persuaded by resume independence. I went to an annual shareholder meeting once that was held in the company's cafeteria. And so it was mostly employees and me. And I got up and I said, fellow shareholders, employees, I'd like you to meet the board of directors. We've got the CEO, we have the CFO, we have the company's lawyer, we have the company's investment banker, and we have another guy. Other guy, I want you to stand up and tell everybody what your connection to this company is, because I don't think this is the kind of company that has actual outside independent directors. And he got up and said, I'm very independent. Everybody who knows me knows how independent I am. I'm the most independent guy in the world. And it turned out that he was in the CEO's jazz band. They played together on weekends. So that's not going to show up on the proxy. But I think it's fair to say that it's hard to consider him as independent. And that is why I say that when I was at my previous company, Corporate Library, which became GMI Ratings and is now owned by MSCI, we established a board rating system, rating boards of directors like bonds, and we rated them based on the decisions they made, because that's how you know whether they're approving insane pay packages, which we've seen a lot of this year, because for some reason, this is what I call we don't want to hurt their feelings, pay packages, because all of the pay packages said, well, they didn't meet their financial goals because of the pandemic, but they tried really, really hard and it wasn't really their fault. So we're going to pay them the bonus anyway. So if a board does that, it's not an independent board, and it's not a good board, and it's not good governance.
Yeah, quite. I was going to ask you actually, in terms of, you mentioned that you've got some sort of system for determining whether a board is doing its job properly or not. What sort of objective measures do you look at then in measuring the efficacy of a board, and what are some of the things that shareholders can look at in that respect when they're making their judgments?
Well, basically, you look at the issues where the insiders and the shareholders may have a conflict of interest. You look at those, you're looking for those agency costs and how well the board addresses them. So, for example, the CEO wants lower variability in the pay package. They want more certainty. The shareholders would like to have a lot of variability in the pay package. If the company does poorly because of the pandemic, we don't care. The company did poorly. If he made good decisions that will pay off in the long run, let him reap the benefits in the long run, but we're not going to pay him for them now. So you want a lot of variability in the pay. So you look at the board and say, if this board cannot get the pay right, if they are doing hurt your feelings pay, or they're doing a retention bonus, or it just happened this week in a huge merger, the board gave the CEO a 7-year contract. That's crazy. Why would they do that? Again, that certainty versus variability. That's a bad board. So that's the first thing that you want to look at. Second thing is that, going back to this big merger, second thing is that acquisitions very seldom add value. And we've got a serial killer on our hands with Warner, because they've had a series of mergers followed by a series of billion-dollar write-downs, because which are sort of the oops of generally accepted accounting principles, where they said, you know, when we told you that this merger was going to be the greatest thing in the world, we were really wrong. So they've had literally over $100 billion of write-downs over their previous business combinations, which does not make me feel confident about this new one with the guy with the 7-year contract. So, you know, if companies are approving crazy mergers, to go back a little way, Sears, which had a very clear business, decided that they wanted to have stocks and socks and buy a real estate company and a brokerage, and you know, it was nuts. And so if the board is approving crazy mergers just because the CEO thinks it would be fun to get a new train set, you know, that's a bad board. That's bad governance. And then the other one is really the financial reporting. There is, even within GAAP, there are clearer and there are less clear financial reports. And obviously the shareholders want the most accurate and complete picture possible, and the CEO maybe not so much. So you want to make sure that you know what you're getting. And if, again, there's a series of write-downs over a period of years, that's a bad board. They're really not paying attention. So you vote against the audit committee, you vote against the comp committee, or you vote against the whole board.
Yeah. Wow. So you mentioned those write-downs, and you mentioned the mergers and acquisitions really not always working out. And in fact, that tends to be, from my reading of it, quite common, where the share price tends to go up when a merger and acquisition takes place. And then when everybody actually moves in together, the story is very different. And it's really quite an interesting phenomenon. It seems to be, to me, it seems, at least in some part, to be rooted in individual human behavior and perceptions, or maybe there's something broader than that in terms of an aspect of groupthink.
I think it's rooted in primarily in money. CEOs get paid more when the company is bigger. Whether that's a good idea or not, you know, we can discuss. But CEOs get paid more when the company is bigger. They get a little bored with their own company, and they want to buy, as I said, they want to buy a new train set and something that's fun and sparkly. And of course, there is I'm just going to say the macho aspect to it, that it's, the bigger company, the more prestige, the bigger Gulf Stream you get to fly around in. And there was one CEO who had 22 country club memberships paid for by the company.
Wow.
Yeah, if he had time to play golf at 22 country clubs, he probably didn't have time to be the CEO. So, so yeah, everything boils down to incentives. And if the incentives are misaligned, then you've got a problem. And so, and with regard to CEO pay, I look at CEO pay the way I look at every other dollar that's spent by the company in terms of return on investment. So if you put $1 into developing a new vaccine, that can be very worthwhile, some new product, or to improving your supply chain, that again, great returns there. But the dollars that go into CEO pay have a lower return than a piggy bank. They're just ridiculous, because what they'll do is they'll say, we'll give you 1 million options, and then if the stock goes up $1, you've made $1 million. And they say, okay, but I'd rather have 2 million options. Well, the stock has still only gone up $1, but you've made 2 million for the same effect for shareholders. So the disconnect between pay and performance is a serious problem.
Interesting. I mean, while we're on this kind of topic, what do you see as some of the biggest threats to business sustainability at the moment?
If you're going to pay people for doing a bad job, they're going to do a bad job, because if doing a bad job is easier than doing a good job. And we've just seen that over and over and over. And the idea that you've got to pay these outrageous salaries to attract top talent is just wrong. What you want is people like, I don't want to say that I agree with everything they've done, but with regard to pay, two good examples were Lee Iacocca, who did a big turnaround at Chrysler and arrived and said, I'm going to take escalated options. In other words, the options at a strike price in excess of today's stock price. And until we really turn this company around, I'm not going to make a dime. But when we do, I'm going to get very, very wealthy. That's the kind of thing that you want. And Michael Eisner did the same thing at a turnaround at Disney. Now, later on, he was, if I can use a Disney product, seduced by the dark side of the force. But when he first arrived, he took the same cash pay that he had been making at his previous job, $750,000 a year. And he also took escalated options. And so that's the kind of thing you want to see. And if a CEO candidate looks terrific to you and you're talking to him and he says, or her, and they say, I won't come unless I get a guaranteed bonus, et cetera, you say, I'm sorry, you're the wrong person for this job. We need the you of 20 years ago. We need the one who wanted to bet on himself or herself. And so I think that's a huge threat. And the lack of accountability is a huge threat. There's a flip side to this, in that, for example, Walmart decided, for one very specific reason, to improve the environmental impact of their operations in China. China wasn't telling them to do it. The United States wasn't telling them to do it. Somebody came to them and said, you can save money by doing it.
Yeah.
And they said, okay. That had a bigger influence on the quality of air in the United States. That operation in China improving had a bigger influence on the quality of air in the United States than any environmental regulation of air quality in the last 25 years. So I think that you can make a market-based change. You can make a market-based argument that can be very effective, but not so long as we allow this kind of race to the bottom, Cayman Islands, Isle of Man, Delaware problem.
It seems to run against the grain of what capitalism is all about, in terms of taking risks and making investments and at a fundamental level, because if a CEO is saying, I want a guaranteed bonus, well, then it's not a bonus, is it? Because a bonus is something that is given as a reward for doing a particularly good, an exceptional job, you might say. You might say that somebody only gets a bonus. Yeah.
Yeah, it's the ultimate oxymoron. I think they call it that because it gets different tax treatment. But yeah, it is ridiculous. But I've got one that's even worse for you. There was a guy, a CEO, who went to prison for financial fraud, and they gave him a retention bonus. Now, I can guarantee you he wasn't going anywhere. But they gave him a retention bonus. The retention bonus just coincidentally happened to be the amount of the fine that he had to pay.
Right. I'm not sure what sort of recruiters he would have been encountering in prison. Perhaps not probably, the sort that...
Probably not a public company. Yeah.
No. Okay, interesting. I'd like to talk a little bit about company values now, because I know that the organizational values are something that the board invariably gets involved in. And I know there's been a lot of pushback, not against company values per se, but against the idea that you can just plaster words like integrity and trust all over your website and the walls of the boardroom, and that's sufficient. So what are your thoughts on how companies can do these values for real, how they can make integrity and trust and probity and all these other things, and innovation or whatever they want to put, how can they really make these things real in not just the verbiage that is discussed at board meetings and what looks good, but percolating throughout the organization into the management and the operations?
Well, two elements are the ones I've already mentioned. You have to make absolutely sure that you've got a strong whistleblower, strong and credible whistleblower system in place. And you've got to make sure that the CEO gets the same treatment as the clerk for the same kind of behavior. You want to call out good behavior, good examples all the time and reward them very publicly. And I do think, not to keep bringing this up again, but I do think that outrageous CEO pay, when you're giving somebody a guaranteed bonus, when you're giving them we don't want to hurt your feelings money, while none of the staff are getting raises, despite the fact that staffs have been incredible at keeping businesses going during the pandemic. That basically is how the message you give your employees then is, go ahead, take home the laptop and say that it was broken or whatever. You have to just show them all the time that is what you're going to do. So I'm going to give you two examples of companies this year in 2021, a good example and a bad example. At one company, the CEO was criminally charged for strangling someone.
Wow.
And the board of directors responded by saying, well, it wasn't really related to his job, so it's fine with us. Okay. So incredible. I would think that sends a bad signal to the company. They can have a plaque on the wall that talks about integrity, but I think that message is canceled by that kind of a response. Then there's another company that I will say the name of because I think they handled it very well. It's called Visuwell. It's a telehealth company. And their CEO was at a hotel where a prom was being held, a high school dance. And he happened to be there and he saw a teenage boy at the prom wearing a dress, and that upset him very much. So he started screaming at the boy.
Wow.
And aside from being completely offensive, have with them phones. So everybody filmed him doing this. And even though later he said it had nothing to do with the fact that the boy was wearing a dress, I was complaining that they were too loud, they filmed it. It was there. And the board acted immediately and fired him. They took down the company's homepage. The homepage was simply their statement saying, this is completely unacceptable. He has been terminated, and we will spend the next few months looking very deeply at how we can be better allies to the LGBTQIA community. You can't ask for better than that. So that's an example of bad messaging about integrity and good messaging about integrity.
Yeah. Wow. So it really starts with setting the tone at the top, doesn't it? And there's that saying, I think it was, if I remember rightly, it was Emerson who said or wrote, I cannot hear what you say because what you do is screaming so loudly in my ears, or something to that effect. So
yeah.
So that really bears out in that.
Yeah. And, some years ago, a magazine called me and they asked me to rank 10 qualities that you look for in a CEO. And integrity wasn't on the list. And I said, I'm only looking for one quality, and that's it. And I can't believe you haven't, you haven't put it there. And yeah, that's absolutely essential. And you've got to be eternally vigilant about it.
Mm,
So, I have a bank account at Wells Fargo, and every time I go in there, I see this sentence on the wall about how committed they are to honesty. And I'm thinking to myself, they've had 4 different corporate scandals in the last
yeah.
5 years. They really need to come up with something a little better.
Mm,
Let me put it this way: the quote goes back to like 1840. Maybe they could update it a little bit. This time we mean it. They could write underneath, and yeah. So let's just talk about Wells Fargo for a minute, because it goes back
mm,
to my most important word, which is incentives. Incentives and externalities really are
yes.
everything that you need to know about governance. So incentives, they told the employees at Wells Fargo, you will get paid based on the number of new accounts you open,
Mm,
not on the quality of accounts, not on the amount of money that goes into them, not in how long those accounts stay, just on the number create. Now, if that isn't a guarantee that employees are going to open up a lot of fake accounts, then I don't know what is. That's just crazy.
mm,
So incentives are very, very important.
mm. Yeah, absolutely. And disincentives as well, you might say, because
Exactly.
it seems as though the Wells Fargo is a really interesting case study, because this was so deeply entrenched. It wasn't like you couldn't just pick out 1 or 2 bad actors and say, oh, well, he or she, they're bad
Hmm.
apples, and we weeded them out and we took care of it. This was really entrenched in management from what I read on it.
And the people who were at the top of that chain were able to leave with millions of dollars
Hmm,
of compensation.
hmm.
Yeah.
That bit that you say about that's definitely speaks to accountability. That the fact that those people are able to leave with masses of compensation, that really is disturbing to me, as I see it, in relation to the whole system. And it's something that that Jeffrey Pfeffer, I know, writes about in his work as well. When he writes, he wrote his book and Leadership BS, which is quite an interesting book, because it says actually there's all these things that are talked about in these fluffy leadership books about, yeah, a good leader is this, a good leader is that, all these normative things that people put forward. But actually, when you look at the reality and you look at some real serious mistakes, but also things that are character based as well. So it's not like somebody's made a mistake, like they've tripped over something, figuratively speaking. It's they've
Hmm.
deliberately done something that is
Yeah.
dishonest or wrong, and yet they have still been paid massive sums for that. Do you see that as a real threat then to the wider system of capitalism?
Absolutely. Because first of all the reasons that you've just listed, first of all, it cancels out any message, any words that you've said about integrity.
Mm-hmm.
It causes both investors and employees to lose faith in the company. And so, I would like to quote one of my heroes, Warren Buffett,
Mm,
who found himself having to take over Salmon Brothers after they got into a muddle. And he said something which I think every CEO needs to say all the time. He said, if you lose money for us, we will be forgiving. But if you lose reputation for us, we will be ruthless.
mm, mm. Yeah, and I think that's the key, isn't it?
Mhm.
That thing about that brand, the strength of your brand and how you are perceived, that is your equity. That's the real stuff.
Yeah.
Because
Yeah.
when we break it all down, we can talk about, there's a lot of talk about stores of value at the moment, isn't there, with the pandemic and the way that markets are going and all the stimulus money that's coming in, as people saying, well, is it, I know Bitcoin's been taking a hammering over recent days.
Mhm.
But then,
Surprise.
yeah, exactly, yeah. So there are these debates, is it gold, is it Bitcoin, and all these sorts of things. But really, when you break it all down and you take away these instruments and different modalities, you're really looking at trust between
Yes.
people. And that's the
Yes.
fundamental currency. I don't think there can be anything that's more fundamental than that. And there's no way of, there just seems to me like there's no way of negating that. Even if, like I said before, I said, how the bad guys and girls can kind of sail off into the sunset and they've got all this money. But the question is, then what? Then what do they do then? Because and there might be a riposte to that, which says, well, actually they still get hired and people still hire them. But there's a hell of a lot of reputational damage that's been done that I think it's very difficult to undo, at least in the perceptions of other people. I mean, how do you go back? You can't go back to that situation and do the right thing instead, can you?
I agree. I wish it were more true. I think you and I both know that reputation, once it's damaged, it's impossible to rebuild it. You can spend decades. It's just like if you have a car that turns out to be very unsafe and you've hidden all of your records about the tests, and it's very, very hard to get that car company's reputation back. But I think quite a lot about a time when I was testifying before Congress, and I stuck around to hear the guy after me testify. And his name was Tom White. He was Secretary of the Army, and he had been in the military. And then after he left the military, he had been an executive at Enron. And ironically, when he went back to become Secretary of the Army, he had to sell all of his Enron stock. So he sold out at the absolute top, which good for him. But anyway, one of the things that he said when he was talking about Enron in the testimony was he said that he was there on one of the most famous moments in all of the terrible, terrible history of Enron. He was there for the tour of the fake trading floor when they had secretaries sitting at terminals pretending that they were trading a commodity. I think it was weather related, when the terminals weren't even plugged in. And they took a bunch of Wall Street analysts through and said, look at this great system we have up. And I thought to myself, this is a guy who went to West Point. They do nothing in the military but stress the importance of honor and integrity. They make that absolutely clear. How do you take somebody like that? Clearly, when he was in the military, if one of the soldiers lied, he would have acted on it. And yet he's there on the tour of the fake trading floor. He knew it was fake and he didn't say anything. And I thought so much about that. Why? Because he's not a bad guy. But I think what I've seen happen is there's kind of an emperor's new clothes phenomenon where people are in a situation. He's like, well, I'm used to the military. I guess things are different in business. I better not say anything. I've got a lot of stock in this company. I don't want to hurt the stock. It's really about incentives, and you said it, and disincentives. And it's very, very hard to create a strong message about the importance of ethics and integrity. And it is very easy to undermine that message, even if you have communicated it. And that's one reason I like to talk about it in terms of risk, because I like to believe that unethical behavior and all kinds of fraud and dishonesty eventually is going to create some kind of collapse. So if you're not managing the integrity of your organization, you are running a huge risk.
Absolutely. That point that you made in recounting what that gentleman said about the difference between military and the business, and saying, well, that's just how business is. I think that's a huge risk, because that makes the assumption that the business environment is inherently toxic and that people are going to maximize their own gain, come what may, irrespective, throw integrity out the window, throw ethics and values out the window. Business is about...
But it can be. I mean, that's exactly what we saw. What I described at Wells Fargo is exactly what we saw in the financial meltdown. Every entity, including the regulators, but also the ratings agencies, the issuers of subprime mortgages, the people who are creating the derivative securities, it was like a game of hot potato. Everybody was getting paid based on the quantity of transactions and not the quality of transactions. So it's just one big externalizer after another. And when the music stops, somebody's going to be without a chair. But as they used to say on Wall Street, I'll be gone, you'll be gone. I'll
Mm.
be, in my private island by then. And I think that everybody, not just people in America, but everybody feels there was no accountability for the financial meltdown of any
Mm.
kind.
Mm. Yeah.
And that has tremendously affected the level of trust. And as I said, this big demographic shift for the millennials who came of age during that era, just like I came of age during the Watergate era, where the only president in history had to resign in disgrace after the vice president had already resigned in disgrace.
Mm.
My generation was very mistrustful of government after that. And I think this generation is very mistrustful of business.
Yeah. Wow. A lot to think about there. Nell, I've got to ask a question on we're speaking a lot about the quote unquote bad guys of business, so to speak, and the impact that they're having. What would you say? You've mentioned having a robust whistleblower policy in place already, which I think is critical if things are going to change. But what would you say are necessary in terms of the character attributes of those board members, men and women, who see something amiss and they do want to take that action? Because that's tough. I've been on a board before, and I've been not necessarily a whistleblower, but I've done the proverbial Gandalf, putting his stake in the ground saying, "You shall not pass." And that was tough. I faced a lot of opposition. I was in the chair and the CEO, in the CEO's office with the chair and the CEO, and I was arguing with them point by point on this. So what would you say are the real attributes that we need in people who want to do the right thing, who see something going wrong for the long-term fortunes of the company? What?
In the book that you have, Power and Accountability, which, as you say, was written quite a long time ago, I have to smile when I think about it, because we had a success story in the book, which within a few years became a catastrophic disaster. So we talked about the company Tyco, which was a huge success story at the time. Later on, the CEO ended up going to prison and was a notorious disaster. So let me just tell you one thing that happened there after the book. So my co-author and business partner, Bob Monks, was actually on the board of Tyco, which is how we knew so much about it. And he started getting concerned about the CEO, and he started complaining, and nobody listened to him. So he came up with what he thought was a very crafty idea. He said, I think we should have a board evaluation. We should have someone come in and talk to each of us to see how we can become more effective as a board. And they said, all right, fine. So they did the board evaluation, and the result came back, and they said, everything is going great on the board except this one guy who complains all the time. So if you just get rid of him, then you're all set. So the problem is, I consider myself an anthropologist of the boardroom, because I've always been fascinated that you take the most accomplished people in the world and put them in the boardroom. All of a sudden, they lose half of their IQ points and 3/4 of their courage. Why is that? One of the toughest, meanest people I ever met was a professor, a business school professor. And he and I were on the committee together, and he was fearless. That's stupid. You're an idiot, that kind of thing. Anyway, one argument that we had was about term limits on the board. And I'm not necessarily, it's not a huge issue for me, but I'm not really in favor of term limits. So I said that. I said, they're kind of arbitrary. I don't think it's really a good idea. And he said, oh, no, you have to have term limits. And I said, why? And he said, well, I was on a board with a guy who was just a raving alcoholic. And thank God he came up against the term limit and had to leave. And I said, wait. You're telling me that the only way you could get this guy to leave was to wait around until his term expired? There's nobody on the board who could sit down and say, I think we need to make a decision here. And so I'm very interested in why these people have such a hard time in the boardroom. And as I said, one reason is there are 11 people who have risen to the top of their various professions by being superb at sizing up the norms and accommodating them.
Yeah.
So if they walk into the boardroom for the first time and everybody's standing on their head, they'll just stand on their head. They won't ask a question. There's a great moment, again, going back to Enron, where the general counsel came to the board and said, we'd like you to waive the board's conflict of interest and ethics rules for this transaction. Now, normally that would be what we call a red flag.
Yeah, a little bit, yeah.
Yeah. But they said, our competition is doing this. We really feel that we have to do it. And not one person said, I need to understand this better, or what is happening here. Nobody said that. They all said, give me a pen, I will sign. And even more troubling, they said, we will give you an update on this to make sure that it's going well. There was never an update, and not one board member said we were supposed to get an update on that. And it's just, I'm concerned about it. And they asked one of the board members why he signed, and he said, no one else said anything. Well, again,
Yeah.
I've said to my children, everybody else is doing it is not a good justification for anything. You have to think about what's right for you. So why is it that so it's not a question to if I can push back on you a little bit, it's not a question of what qualities we need on the board. We know what qualities we need. We need smart, honest people, right? They are smart, honest people, and yet they're doing a bad job. They're not acting smart or honest. What is wrong? What we need is a better system, starting with right now. If 99.9% of the shareholders vote against a director candidate, he or she still gets elected. That's just wrong. We have to be able to replace directors. The SEC has the authority to ban someone from ever serving on a public board again. They never use it. They have to start using it. We have to have consequences. That's what we have to have. So we have the qualities we need. We just are not having the going back to incentives and disincentives. We don't have the incentives in the boardroom for them to do a good job. And there's a natural human tendency to dance with the one who brought them to the party, and not the CEO. So I'll tell you a good story about a director. There's a director who is on the board of a bank, and he was not a banker. He was not an accountant, but he was on the audit committee. And so he had regular meetings with the CFO, and he showed up for one of those meetings, and a person on the CFO's staff who had always attended the meetings wasn't there. And he said, is she on vacation? Is she sick? Is everything okay? And they said, she quit. And he said, okay. And he went home and he called her. And he said, did you quit? And she said, no, I was trying to be a whistleblower and I got fired.
Wow.
That's a good director. Okay. He didn't have to be an accountant. He didn't have to be a banker. He just had to be smart and honest and ask good questions. It's, if you're, I talked to a guy who was a director of General Motors some years ago, quite a long time ago. And he said the briefing papers would be delivered by forklift. Just this gigantic amount of files that would be shoveled through his door. And then you would go and you would nod. There's a great PG Woodhouse story about the nodder, whose job was just to nod whenever the CEO said something. So they would nod. And he said there was never any time listed on the agenda for questions or discussion. It was presentation. Get out your new car, because they got 2 new cars a year, go home. Wow. So you want to make sure that there's plenty of time for questions. You have to have executive session meetings with the executives out of the room. If the CEO is prohibiting you from having direct conversations with anybody on the staff, particularly anybody who might be a good successor to the CEO, then it's not a good board, and they're not effective. They're qualified. They're just not being effective.
Yeah. One of the things, it's interesting you mentioned that, Nell, because one of the things that really struck me when I was on a board about systems and structures and making time for certain things was how much power the person who writes the agenda has. I became more and more throughout my time, because I was quite young when I was elected to the board, I just finished a master's degree, and the people that I was interviewing, they said, "Oh yeah, you'd be a good fit for our board. You're young," and at the time I think I was the youngest there by maybe a decade or two, and so I was a good fit. And I was quite quiet to start with, but as I grew into the role, I started to notice certain patterns and certain things that were happening, and I just realized how much power those have who are actually writing the agenda and setting the agenda, and not just in terms of what's there, but what isn't there, and how much time has been allocated as well.
Exactly. And that's why when I talk to directors, the first thing I ask them is, who sets the agenda? How far in advance do you get the agenda? And are you able to add things if you want to?
Yeah. Great point. So, Nell, any tips for anybody who wants to get on any boards other than being best mates with the CEO?
A good golf game, maybe. Yeah, best way to get on boards is to start by getting on nonprofit boards, what your local community organizations. That will teach you a lot about how boards work, and it will provide you with good contacts. And then that you could join the National Association of Corporate Directors, go to some of their training sessions, and again, that will get you started.
Super, really interesting. And I can't finish this podcast without talking to you briefly about movies, because you are also a film reviewer and writer as well. Is that correct?
Yes, absolutely. I've been doing that now for 26 years. Yeah.
Wow. So which the inevitable question, which films do you reckon can best teach us about corporate governance?
I actually have quite a long list, but I'll tell you some of my favorites. Certainly The Big Short. You're never going to get a better film about corporate governance than that. The Wolf of Wall Street is another really good one. Other People's Money, very good. Obviously, Wall Street, Gordon Gekko. But I'm going to recommend one that no one's ever heard of. I'll recommend two that no one's ever heard of that are my two favorite movies about corporate governance. One of them is called Owning Mahoney, with Philip Seymour Hoffman and Minnie Driver and John Hurt. And it is based on the true story of the largest bank embezzlement in the history of Canada, some $22 million, all of which the bank vice president lost gambling. Didn't buy a house, didn't buy jewelry for his girlfriend, lost every penny gambling. And the reason that movie is so great is that it's very clear that everybody in the movie, the embezzler, the Royal Canadian Mounties who are looking into it, the loan officer in the bank who turns somebody down in the beginning, and later those funds are the ones that are embezzled. Everybody's estimating risk all the way through. And it's a fascinating movie, very, very well done. So that's Owning Mahoney. But my favorite movie about corporate governance, and the one I showed my children and said, this is what mommy does at the office, is called The Solid Gold Cadillac. And the first 10 minutes of the movie take place at an annual shareholder meeting. This is 1954. So the outrageous CEO pay is something like $125,000 a year, but okay.
Allow for inflation.
A shareholder with just 10 shares shows up and starts asking questions and turns the company upside down. And if you just add 3 zeros on to all the numbers, every bit of it is 100% applicable today.
Fascinating. That's really interesting. Nell, thank you so much. In closing, I have to ask, is there anything that you are working on at the moment, or anything that you've produced, a book or any other products that you would direct us to in learning more about corporate governance?
Oh, well, thank you very much. Yeah, I have a blog at my company, Value Edge Advisors, where I put up all of the articles and commentary that I think is interesting. So I think people should start with that. You should follow the hashtag CorpGov on Twitter, where a lot of people put up really interesting things, and the Harvard corporate governance blog. I write for them sometimes as well, and I think that's really good.
Super. Nell Minow, thank you so much for your time.
My pleasure.